Today we're going to talk about liquidity, volatility, valuations, and come to the question, is I buy SPY still good enough for this environment? Enjoy.
Holy fuck, you shit, it's a dinosaur! Jesus Christ, what the fuck?
Welcome, ladies and gentlemen. See, I got the lady right this time, Nick. Welcome to the Tactical Brief. It's already February. We have a new president. Markets are doing weird things. Palantir just made overnight 25% in, increasing the corporate valuation the stock market provides. And I thought, I'm sitting here with my good friend Nick, the man who is managing fantastillions of money as a chief investment officer and as a humble market maker who actually never knows whether markets go up or down. I'll pick your brain. Hey, Nick, thank you very much for your time.
Welcome. Good to talk to you again.
Well, it's been almost a month because we had so much stuff on our channel that I thought I bring the other guys in because our whole investment process is developing nicely and we have now stuff to show. But obviously, there's a lot of interest in your take on the market. And let's dive right into it, because one of the things that's stuck in my head for the last week, when I was a young market maker, I was at a conference in Munich, Frankfurt, I don't remember. And Dr. Jens Erhardt, he is one of the big German investment managers at the time. He was selling a newsletter and he has fantastic performance, consistency now for decades. And I was a young man and I said, could you explain to a stupid market maker, what's the general assessment? How do you approach markets? And he said, Mr. Wegener, it's very, very simple. Yeah? As a guideline, if money supply goes up, you want to be long. And if money supply doesn't go up or down anymore, you want to be short. In simple terms, for you as a market maker, if the line moves from the bottom left to the top right, that's good. And if it goes down, that's not so good for markets. And I thought, thank you very much. That was brilliant. And hey, what is the liquidity situation at the moment, Nick? Because yes, we have Trump and everything is hunky-dory and it's doing a lot of stuff which is quite impressive. But if I take this basic assumption in, there needs to be money to buy shit. How's the situation we have at the moment? What do I use to approach it?
Well, I mean, it's interesting what Dr. Jens Erhardt said. I think when I was growing up as well in the market, I also was looking at money supply. But money supply is the actual number that's through the economy, whereas liquidity actually measures, the amount of capacity, if you like, within the financial economy, as opposed to the real economy. And nowadays, and the argument from cross-border capital, Michael Howell, is that that's become a much more important factor because the level of global debt is so high that actually people don't borrow money to build new plants these days. They actually borrow money to refinance. And that itself is a really important thing right now because, we just had the quarterly refunding announcement from the new Treasury Secretary, Scott Bessent. The implications, obviously, is always going to be how much are they borrowing at the short end? How much are they borrowing at the long end? So come back to the first question, where's liquidity? So firstly, originally you said money supplies, and money supply is actually coming down globally, and it's coming down globally effectively because we just convert everything into dollars. The dollar's a little bit stronger. And actually, money supply in the US, the argument is from the monetarists, is that you need at least 6% a year money supply growth in order to avoid, slipping into a deflation. Money supply is growing below 4% on an annualized basis right now. And, that's the reason why ultimately inflation's been coming down, because money supply growth is below this kind of minimum threshold that you need for 2% growth, 2% inflation, and a little bit of money going into the financial market. There's money supply. Liquidity has been, it needs to go up regularly and steadily. But, there's been a pause in global liquidity. And this is the thing that's sort of causing a lot of concern. Where is the money going to come from to refinance, or where is the balance sheet capacity going to come from in order to refinance the debt that's falling due? And this is a kind of a very critical thing. And that's where it comes into, it links in with what's going on with what Scott Bessent was saying, the quarterly refunding, because the US have to refund not just the debt which is falling due, but also the deficit which they have for this year. And the expectation was, and what he said for, for the last few months, when he was being very critical about Janet Yellen's approach to refunding the US debt, he was saying, well, look, she was borrowing everything at the short end of the market, T-bills, and she wasn't borrowing at the long end of the market. And what that did, and we had that conversation recently about, there never was an inversion, it was fake. And that was, the fact that she steered everything to the short end. Well, Scott Bessent said, well, I think we're going to have to term out the debt. We're going to have to borrow more at the long end. This quarterly refunding announcement basically said same as before, which I must say is maybe he's being cautious, but I think he's saying for this year he's not. It doesn't appear anyway that he's going to be changing the approach of Janet Yellen. So that means still a lot of issuance in the short end of the market. And so to some extent, that should bring relief to 10-year bond yields, because it's when you're borrowing at the short end to when you're borrowing at the long end, it's a different investor base. Banks can invest in T-bills. Banks don't go and buy long bonds. So now he's issuing mainly in the short end of the market again, allowing himself the flexibility to not to sort of stress, a part of the investment community that wasn't tapped before. So he's effectively, again, trying to cap yields in the long end of the market. And he came out with a statement yesterday or the day before, basically saying that the game, the goal of the administration is not about short end yields at all. Yeah, of course it is. It's also about the long end yields. And that's very important, of course. So he's saying, well, previously the people who manipulated the 10-year yield was the central bank when it was doing QE. Then it was Janet Yellen when she was suppressing the issuance, and now it's Scott Bessent doing exactly the same thing, suppressing the issuance. So it's clear that they don't want yields to run away in the 10-year, and they're very worried about, or at least they don't have a solution in place today to manage failed auctions. And I think he wants to sort stuff out in his department so that he is able to control the 10-year in a different way.
It's always this word coming up of the vigilantes, yeah, especially on the long end of the curve. And we talked about that as well, where, well, I basically said to you, if you want me to invest in 10 years, I want more yield for the risk I'm going to take. So I'm not getting that done at the moment, right? If he's still playing around at the short end and they're not issuing something at the long end, which could improve rates into my direction to give me a little bit more money. So what's the long game they're playing there? If he can't do anything, they're not doing what they originally said. Yes, we are shifting short-term financing into the longer sector. How are they getting out of this? Are they all just hoping growth will magically appear and make the world a better place?
Well, growth doesn't necessarily help you refinance debt. But I think what he's realizing, or what he's, his early homework in the department was, because of the sheer volume of issuance that needs to take place this year, he would probably be killing the 10-year. And I think he's a little bit worried about runaway yields in his first year, because everyone's going to point fingers at the hedge fund guy and say, well, he blew it. So I think he wants to, I don't know, perhaps he wants to sort of make sure that he understands what the implications are. And if he wants to force pension funds into that part of the curve, he needs to have legislation, or he needs to have these guys all around the table first. And what we spoke about in the previous video was about the term premium, was this uncertainty factor. And it's that uncertainty factor that raised term premium in the 10-year from, it was negative, and now it's about 50 basis points, or at least it was in December. That may well have come down now in the last week or so, as the risk of greater issuance in the long end has come down. So, we're back to that game where the US knows it's got to issue a lot of paper and is relying on the low duration T-bills area in the same way that Janet Yellen did. Slightly different because of reverse repos. We'll talk about that. I'll let you ask that later, maybe. But I think he's decided to be a little bit more cautious about the issuance, purely because of the sheer size of I think it's something like 8 or 9 trillion this year that needs to be refinanced. I mean, it's stonking amount.
Because especially you just mentioned it last week, yields came down. And I almost had the impression, if you listen to the news, as if the market has sniffed out a little bit, maybe the policies Trump is introducing might work in terms of growth and checking inflation, especially when they really are being serious about. He had that in his first term when he said, for every new regulation I bring in, we have to cut 2. And on average, I heard in another podcast, I think it was Pomboy, she said it turned out to be 5. Now the rule is for every new regulation, they have to cut 10. And I took that together with a survey, I think it was in the US or in Europe. However, I think they all think the same. They've asked CEOs of companies, what would you prefer, tax cuts or deregulation? And not one of them said tax cuts. And the explanation was simply to say, if they take deregulation off our back, stuff gets cheaper. When things get cheaper, prices come down. We make more earnings. We can pay more taxes. Our investors will be more happy. Don't bother too much with the tax side of it. Get the regulation down. And I thought, okay, maybe that is the mitigating factor, which could really rescue these markets on a medium to long-term basis if the policies start working.
The dream team management of the economy in the US right now, if you could write down what you would do if you were president, I think you would probably say, yeah, get rid of legislation, make sure that you're not overburdening the population with stuff like that, rebuilding your manufacturing, cutting waste in government. So
allow smoking in bars.
That would be nice. Again, going back to that kind of world where you'd say, yeah, smaller government is good. And let's not forget, so part of the, this is semi-political, I guess, but what was going on for many years is that America was spending a lot of money on wars. Money was obviously sort of finding its way into foreign governments, finding its way into the hands of corrupt politicians, and not necessarily to aid across the world. And so it was kind of wasteful spending. And surely the American people now should be happy that they're going to cut out the waste, and hopefully they use the money to either partially pay debt or give it back to the people in the US. But I mean, that kind of makes a lot of sense. And I'm really surprised that sort of some other governments aren't saying, hey, we should do that in our as well. We should cut regulation. We should cut the size of government. But of course, that's not taking place yet. Maybe people want to see the results of it all. But, everything you see coming out so far
It's
the
in their
thing
nature.
that
They
they are
can't do.
cutting
They
is
can't. They
incredible.
can't do it, Nick. It's in their nature. Our socialists all over Europe, in the UK, they can't do it. You can't roll back regulation. Yeah? They want to tell people how to live their lives. And Millet was the first who said, "Let people live their lives on their own." And now Trump seems to be doing the same. Yeah, let's see what's going to happen. But the big point about this all, we always say, yeah, stock markets are forward looking, and then it's the old adage, but somehow they never see it coming. Yeah? What is happening if Trump does what he wants to do, reduces regulation, and suddenly all this cash piled up in equity markets goes into the real economy because there are opportunities for investments? Meaning the term now liquidity. What's the liquidity situation for the equity market if we would assume that a percentage of this money, which is at the moment in Nvidia, Palantir, Apple's, and all the big names of the
Absolutely.
world, is going back into the real economy because suddenly there are growth rates. Your money gets more bang for the buck. Are we at a situation where they could be endangering the markets, or am I just making stuff up?
No, I think that's a very realistic, plausible kind of explanation. If you just simplify this thing with a basic example, you say, okay, they used to give the money to a wasted cause, and some corrupt politician ended up with the money somewhere around the world. What did he buy with his money? He bought a yacht, he bought a house probably in London or in America or wherever it is, or on the coast somewhere, on a beautiful stretch of beach. He bought some Bitcoin, he bought some gold, he bought some Nvidia, and that's where the money went. Well, okay, now you don't give that money to the corrupt politician, and the money goes into the people in some way, benefits or services or however it gets translated. That money, therefore, isn't in the financial economy, it's in the real economy. And, the financial economy has received a big boost when, the country with the reserve currency of the world
Yeah.
is writing checks everywhere. And if you stop writing checks everywhere, then something has to give, right? So we have to sort of think about this. Is what Trump is doing actually going to trigger a decline in growth initially until growth picks up? Because that's the other thing to consider, is that the economy has been growing because there's been a lot of spending out of government over the last years. And if you say, well, your 7% of GDP goes down to 3% of GDP, which is the target of these guys, well, then 4% of GDP spending is going to disappear. It may get reduced deficits and all of this stuff, and it's wonderful, but 4% of GDP is a big number to take out the economy that the economy was used to, money coming in from the rich guy somewhere here and there. So there is, I think, a real risk that that the economy does suffer initially, and for different reasons. So, firstly, government spending is coming down. Investment requires certainty rather than uncertainty.
Yeah.
So, is Trump going to do this thing for the next 4 years? Is there going to be a change in sort of the internal politics in 2 years' time in America? So the investment side of things is a big question mark. And then we're kind of hoping that the consumer at the end of the day is going to benefit. But I think the consumer is always at the end of the chain somewhere. So question mark. I'm sort of leaning towards lower growth initially before the economy starts to get steam again as they start to build factories and production and all of this stuff in America, which would take years, of course, and a huge amount of investment and a huge necessity for refinancing, for
Yeah.
financing and refinancing. Where does it come from? You're right to ask that question. And so I'm sort of very cautious about the outlook initially for the next couple of years. And the only thing that I think is kind of potentially positive for stocks is if Trump sort of takes the money from tariffs, puts it into tax cuts, let's just say.
Yeah.
So the corporates get their earnings growth continues and strong, and that's supportive for equities. But I think sort of around the edges, the equity market isn't as in such a good position, in my view, initially, and therefore vulnerable.
He said that last week for the first time, what I always hope, because he actually made the analogy and said America had the biggest fundamental growth in its whole history before the inland revenue was introduced. Everything was financed by the external revenues they had at the time. And I already said, that would be the real zinger. If he says, we have now an external revenue, it doesn't bring in as much as the internal revenue, but we take this money and cut everybody's taxes by this amount. Then you would have the golden time everybody's preaching. But could that be the situation? Yeah. Okay. At the beginning, it will be difficult. We saw that the whole United States growth was actually money spent by the government. Yeah. If you really look at GDP and how much the deficit was rising, it was pretty much a one-on-one game. Could he eventually be punished by financial markets for doing the right thing? Because suddenly liquidity is draining. Yeah. From the entrepreneurial side, people choose to invest in real stuff, because in the future it will bring them higher returns. So that is a way. The government at the moment is still playing on the short end of the curve because they have to. They can't really have a chance. And then there are a couple of other tools they can use. And I always have this because it seems to be a topic, the reverse repo facility. And at the moment you hear, it's almost drained. Yeah? First of all, explain to me again, because I'm a stupid market maker, what's actually the reverse repo facility and what does it do?
It pays interest to money market accounts. So this was basically set up so that the Fed can steer monetary policy the way they want to without some money market funds, which are sort of always awash with money. So if they didn't have a facility to invest, they would have to buy T-bills, which is okay. Remember that, at the time they weren't issuing so many T-bills and we hadn't had COVID. So what they would have done was by buying T-bills, they would have suppressed the yield of T-bills. So when the Fed say, we want interest rates at, whatever it is, suddenly there's the T-bill market, which is trading at a different level. So I said, well, we don't want to sort of confuse people. So we'll just sort of give them something else to invest. And we'll call it a reverse repo account. So they go into a reverse repo account. They get a nice rate of interest for their money. And of course, this account managed to collect something like $2.5 trillion. And as money was going into this reverse repo account, effectively, there's less liquidity. I use inverted commas there because it's, money market funds, it's clearly they're not in the game to do anything other than just invest the money away. But nevertheless, it is part of the calculation for liquidity. So the money's gone in. So the liquidity number was draining as money was going into reverse repos. So as Janet Yellen started to issue majority T-bills and less 10-year bonds, all these money market funds were encouraged to go and buy the T-bills. So they went and did that. So now this reverse repo account is empty. So your next question is going to be
just open up the chart for me just to visualize that. So from the beginning of 23, when it was at a top, it was drowned till we are where we are at the moment of 78 billion or something like.
Yes, so it's gone from empty. 2.5 trillion to 78 billion. So that's it's a big drop.
And remind me again, what did equity markets do while this reverse repo facility was drowned?
Well, hang on. Firstly, when the reverse repo account was building, the equity markets fell.
Yep.
When the reverse repo account started to drain, effectively, the money it's in the system because they are buying the T-bills. So what's happening is the government spend the money, issue T-bills, and the money market fund go and give them the money this way. And that's basically, why it's a liquidity positive. So as the 2.5 trillion goes down to almost zero now, it is, right? That is, and the argument of Michael Howell is, well, that's effectively stealth QE. So on the one hand, the Fed were claiming over the last couple of years, we're doing QT because we want to do quantitative tightening because we want to reduce the size of our balance sheet. And of course, they did that, 40 billion a month or whatever it was. But on the other side, the reduction in the reverse repo account totally outnumbered the amount of QT they were doing. And effectively, this is where the Fed were effectively putting money into the system whilst they were saying they're taking money out the system. And this is the stealth QE that happened over the last couple of years. Oh, and lo and behold, stock markets were up.
So what's the solution now? The punch bowl is now empty. Yeah. You can't drain further liquidity out of the reverse repo. We're at 78 billion. Yeah. We had that earlier, the conversation offline, that if NVIDIA can lose 200 billion in market capitalization on a day, 78 billion doesn't sound like a lot. So starting at 2.5, 3 trillion, going down to nothing, where's liquidity now coming from if this hose is empty?
So Scott Bessent has just said, quarterly refunding announcement, we're going to stick to the old plan of X number of T-bills and 5 years and 10 years and whatever else, same procedure as always. So he's going to issue some T-bills. So he's going to say, well, come on, guys, come on, reverse repo guys, come and buy my T-bills. And they say, well, we haven't got enough money to buy them just yet. So where else is he going to look? So what is likely to happen, and it's been talked about over the last couple of years, is already, so this is not new idea, but it might be newly implemented. And I think that's, what Scott Bessent is probably going to be working on, is to allow banks to buy more treasuries without sort of impacting their your capital they've got to hold and all risk capital and so on and so forth. So they have a limit of what they can buy today. So banks create money. So the easiest thing in the world is to allow banks to just go and buy more of these T-bills. And the short end of the market is really where the banks play. So this is ideal for them. So my guess is you'll start to see legislation come in, which is, the sole purpose is to allow the government to continue to issue T-bills and eventually bonds as well. So once this legislation is in play, it could well be that the banks start to migrate their holdings also, up the curve, as it were. But, we have to see it. I don't think it exists today, but I think there's been a lot of talk about this thing from, the people in the Treasury and so on and so forth over the last year or so.
So reverse repo is emptied. The legislation to provide the market with more liquidity isn't quite there yet. And Mr. Powell seems to be, can change his mind any minute, reluctant to take interest rates further down at the current situation.
Well, he's reluctant to stop quantitative tightening, which is more to the point. So if he were to pause QT, then that would be a source, if you like, of extra liquidity for the markets. But at the moment, he is still, following the QT plan. The interest rate story, I don't know what the maths would be, but it will have hardly any effect on liquidity per se. And, the most important thing is not the rate of financing, but the balance sheet capacity to refinance. And, Powell does what he does, but I think the bottom line is at some stage, the Doge committee will probably come in and say, right, we've gone through all of these wasted contracts and we've saved some money for the government. Right. And there's another thing on the list. It's called interest rates, and that's a trillion. So what are we going to do about that one? And they will find a way to get that number down. And they may not even need to say anything because, again, is inflation going up or is it going down? And it is still, it may be stubborn, but it is not going up. And for that reason, the necessity to have interest rates, real interest rates, at such a high level, is questionable. Why do you need real interest rates so high? Big question mark. For me, I don't get it. And it could be just a Powell thing. I'm sure under a new Fed chairman, they might see the world differently.
Well, if the economy is doing well, as it apparently did over the last years under President Biden, and it's still doing fantastically, best economy ever, you wouldn't believe it. I can't do a Trump impression yet, but there is not really a need to provide the market with additional liquidity because we have this split between the reality, the real economy, and the asset bubble we have. And that leads me to the other point, because you've mentioned that over and over again. It's all about the corporate earnings. And we are in earnings season right now at the moment. And the mega caps seem to at least deliver a mixed picture at the moment. So if liquidity is a wash and earnings are not further increasing, and we have an extremely high valuation, it's the old game. I heard this line a couple of weeks ago and I loved it. So it was about the Sharpe ratio. Yeah? Sharpe ratio simply for our listeners, what's the return of an asset? You deduct the risk-free rate from it and divide it by its volatility. Yeah? By how much risk are you taking for the earnings you're getting? And the S&P, let's say, made 30%. The risk-free rate was at 5%. You had 25 volatility at 12%. You had a Sharpe ratio of 2, which is unheard of. And the slogan was, why do I care what's happening in all these asset classes, markets? I buy SPY. And I thought, are we still in this situation where I can say, I buy SPY? Or is it now take a foot on the brake? Because I was talking about that from a different angle for the whole last year. I thought, where's my recession? The Democrats are surely not building the best performing economy. Now it's different. And did not hear anybody talking about recession anymore since Trump's in there. Is that also a sign? We saw the last short seller, Hindenburg Research, folding its deck 4 weeks ago.
That's usually a sign of a top, if you ask me.
A big signal, isn't it?
That's usually a sign of a top when the last bear throws in the towel. I mean, there are a few other bears, sort of you see them, very intelligent people who are still in the game there, waiting for the bear market. But one thing that you should consider when you're buying an equity or whether you're buying a bond is whether or not you're being paid for the extra risk. And obviously you could say, well, there's no risk in equities because they always go up, whereas the bond market last couple of years wasn't doing very well. But still, the maths is between a guaranteed return, for the length of your investment, versus what's not guaranteed, and that's the equity risk premium is supposed to compensate you for that. So the equity risk premium is about 4 and a smidge. So whatever.
It's negative towards bonds.
So 4 and a bit is what you'd expect for the equity risk premium.
Yeah.
We're earning 4.5 on treasuries or thereabouts. So 4.5 plus. So you expect a 9% return, 8.5, 9% return on equities.
Yeah.
If you expect 8%, 9% return on equities, well, the S&P this year needs to go up. Let's just say we started the year at 6. So 8% of 6 is a big number, it's 5. So you're at 6.5. So the S&P, if it goes to 6,500 by the end of the year, then with the maths, you have only just covered the equity risk premium. You haven't earned more. And you've taken the risk of the uncertainty of, have we got lower growth initially, or what's going to happen with tariffs? I don't know, and this uncertainty. So there's a real question mark over the value of bonds and equities now, My own view was that yields on bonds go to 5.5%, terming out the debt, term premium goes up to 100, get 5.5%. Let's just say that 460 was the higher, and that was not, and we don't get there because Scott Bessent is now playing a different game. And suddenly you'd say, well, okay, so if Scott Bessent wants to put a cap on yields, well, then I'm reducing the risk of the bonds that I didn't have in the last 2 years. So I've not only got a reduced risk in buying bonds, I'm not being adequately compensated for owning equities, even if we see 6,500. That's the kind of thought process that you've got to go through right now in your allocation. And
Yeah, well,
let's not forget, sorry, one last thing.
yeah.
Right now, equity investors are as invested as they have ever been. So there's no, it's perfectly priced. They're all in, right? People like Palantir are trading at 78 times sales, not earnings, sales, right? And and a large chunk of their income in the last quarter was also in coupon interest from
Yeah.
buying T-bills. This sort of interest rate that they're in. So I'm
But
not sure.
you know, we're both old geezers now. This conversation could have happened in 1998, and instead of AI, it would have been the internet. And all the points you made are absolutely valid, and I'm with you on that. And what did the market do? It doubled.
Yes.
Yeah.
Yes, we could have also said that in 99. So therefore, how do we get out of this conundrum where
Yep.
we talk about, we do a lot of intelligent thinking. We have all of this knowledge behind us, and then we make an assessment and we say caution. And then we look at the market and we look at the technicals, because for me, that's why I shifted from this kind of macro only thinking in the early 90s
Yeah.
to a technical thinking, because I'm hoping that gives me a little bit more of an edge in difficult times. And so that's where I'd say in 1998, I probably would have said, no, it's still going up.
Well, I was just in the screens and saw these things happening all the time, and I couldn't really bother about it. But the older you get and the more you see in the markets, it's really, it's usually when you finally get what you want, and the Trump administration is a big positive on markets, on the economy in general. Yeah? Nobody who is in their right mind would doubt that, because the social experiments fail everywhere. No example. Usually get then great disappointment if the right guy does the right stuff and the market said, nah, we're not liking it. We want more now. And you can't, at the valuation levels you just described, we can't deliver more in these markets. So my little I buy SPY should not be the prevailing theme for 2025.
I think the way that I would put it, and something we spoke about last year, towards the end of last year, that the expectation was that, if we think we're at the, let's just say, tail end until we have that certainty about growth, and they've built the factories that they need, and the economy is going like gangbusters, and we haven't interrupted the global trade through all of this sort of adjustment processes on sort of trade surpluses and deficits. Until that happens, then we think about volatility, and therefore we need to be more active as investors to look for times where we want to benefit from a rally in the market, and times where we want to put on some protection strategies to manage that risk. But I don't think it's a buy it and forget scenario again. I think it is a buy it and manage scenario.
Yeah, with you on that. You mentioned volatility. That's the game I'm playing at the moment. I think there is somebody in the market who is suppressing volatility spikes. My conspiracy theory. So it seemed to be a natural top at 25 when you look at the futures market. Somebody's selling at these levels. Fine. They're selling only as long as something really big happens, like in 2008 or 2020, yeah. But at the moment, it's this at the moment volatility has come down again. Yeah, it's always this. You have to pay the carry to carry volatility, but it's the only we call it wonderfully anti-fragile asset we have. Yeah? If things go pear-shaped, this thing spikes, and then you can earn back a lot of the carry you paid in the meantime, and you sleep well. So yeah, my strategy is still mostly volatility driven on the trading side. When it's high, I like to sell. When it's cheap, I like to put a little bit protection in. My last pet love, gold, Nick. Is there still upside potential?
Well, yeah, but the higher it gets, where is the final target? It's like, is there upside potential in Bitcoin? Yes, there is. How much volatility do you want to see
You
before?
see, that's where you're disappointing me. Dr. Achim Illner said to me, oh yeah, Bitcoin, it can be 100x. I want you to say, oh, gold can be 100x because I own gold. I don't own Bitcoin.
Well, put it this way. I mean, let's just sort of come back one step from the debate on, equities. Is it an easy bet and is it not an easy bet? And, what else can you do? So before you jump into the alternative asset space, we talk about international equity markets
Yeah.
for value. We talk about the bond market being now priced for the risk you've got in equities, so you've got that as an alternative. And then you've got these two asset classes or these instruments of gold and crypto where you can also be invested. The volatility on these things is actually not as much as some of these equities, I must say. So if I look at Bitcoin volatility versus some of these equity names which are sort of crazy, Bitcoin, it's like it's a blue chip.
A widow investment.
Almost. But yeah, so gold, ultimate target. We talked about this before. When you break a long-term sort of cap trend, that was at 2000. That was a high in, I don't know, 2011 or 12. Yeah. We broke that. So at some stage, gold's going to go to at least 4,000. And along the way, it will find resistance points because at the end of the day, if you've got someone in America who is not spending money like it's growing on trees, if you fix that problem, then you're fixing ultimately the deficit problem. Then actually, what do you worry about the money that is sort of, we've been talking about why do we need these other hedges? We need them because until we get to that point, the monetary hedge is important in our portfolio. Yep. Now, ultimately, 4 on gold, I think it stumbles at 3. Bitcoin, we've got this sort of cycle thing that probably, I can't remember what it was. Let's just say around end of March, it sort of starts to make its last push up for this cycle, up towards the 135,000 there or thereabouts, 150, I don't know. The sort of the 100x story is for the next years, but I play in cycles and shorter time horizons because I will not live as long as Master Yoda. So therefore, I have to, I don't just want to sort of collect these things. I don't want to be buried with them. So
nice.
I want to use.
Slip the Star Wars analogy in here. Excellent. No, Nick, thank you very much for that. I just want to have one address to any world leader who is listening to us at the moment. Another thought that came me while ironing. If Trump is not threatening you with tariffs, are you irrelevant?
Well, I think you're just probably you're probably too small for him. Too small or too far away.
Because you have the European Union, yeah, and they are a prime target, a bunch of socialists sitting
absolutely
there.
Right. I think
and first he addressed the Canadians, the Mexicans, the Chinese, and talking with the UK that they should do things in a certain way. He hasn't addressed the European Union now. Is that the singer he's waiting for? Or
that's coming. But think about what he's doing. He's going to cut wasted spending. He's going to shrink government. He's going to increase taxes from external sources, not internal sources.
Yep.
This guy wants to fix the money problem. So he's not going to let the Canadians and the Mexicans get away with just putting a couple of 10,000 troops on the border. I think he wants some money somewhere along the way. So this guy is a money collector right now from the outside to bring into America. And, that is the game. And the European Union, you got to pay your dues.
Excellent. Nick, I think we've covered all bases for now. Looking forward for our next talk. Next talk, I would kindly request you to get your magic charts out again and look at the commodity sector and the Bitcoins and gold, obviously.
Indeed, I will.
Thank you very much. Last word? Then I do the last word. If you are interested in our conversations here, visit Nick's channel. Nick has good analysis coming out, and they're not like this one is for an hour conversation. It's short and snappy. It's 20 minutes going into different asset classes. He applies his special skill set, and you'll find the link down in the description. I'm an ardent fan. I share it with all our students here at the Tactical Brief. Become a fan, give us a like, a share, and spread the good word. Thank you very much for watching us.
Thank you all, and thank you, Torsten. That was very nice.
Thank you. Bye.
Bye-bye, everyone.